Okay, well, you know what they say, bad rehearsal, good performance. I don't know what they say about not being able to log in. But let me give you a little bit of preamble before I get into the presentation about what happened this week with, what happened this week with the Fed. So, because it's, fairly important. So we had earlier in the month, we had a inflation reading from the United States, and it was hotter than expected. And the reaction of the market was negative, and the way that the fixed income market reacted, it basically started indicating that the Fed would need to raise rates more quickly than the Fed had already outlined. So if you want to think about what's influencing monetary policy right now, and of course that's what's influencing the equity market, you basically got three factors, right? You got factor one is what the Fed is saying they're going to do. Factor two is what the market thinks the Fed is going to do, which is not necessarily the same, but obviously influenced by the first thing. And the third thing is data, which may change people's view on what the Fed needs to do. So basically what happened was until, at the beginning of the month when the market really began selling off, you had what the Fed said they were going to do. You had some hot data, which basically changed what the market thinks the Fed is going to do. And then the Fed ultimately on Tuesday raised interest rates by 75 basis points and indicated that they would be a little bit more aggressive raising interest rates. So the Fed's statement got in line with what the market thinks that they're going to do. So now those two are in line, the data is out, and the only thing that can change is if we have more data indicating that the Fed can't, if we have more data indicating that the Fed, should raise it, the Fed's program isn't working properly, then if we have more data like that, then there'll be more, the market will change and people will assume the Fed needs to raise rates even more than it's currently planned. So what actually changed with the Fed? So at the beginning of the month, right, what we were looking at in terms of the Fed was going to raise interest rates to around 3.4%, and they were going to reach their peak interest rate at September or October of next year, 2023. Now, it looks like the market is assuming the Fed is going to raise rates to about 3.8 or 3.9%, so more or less 50 basis points, which is not a whole lot, about 0.5% higher than what it thought before, and it's going to reach that peak rate instead of in September, it's going to reach it like in June. So basically what's going to happen is you're going to raise interest rates 50 basis points more, and it's going to happen 4 months quicker than anyone expected. So put those things together and you're having the Fed is fighting inflation more than what we expected at the beginning of the month, and that was bad for stocks, and stocks have sold off a bunch. And now we'll get into the regular part of the presentation. Okay, so here's a little chart. Here we were, just to put in perspective, on May 5th for our last webinar, and you can see we're now considerably lower, although we did have like a little bit of volatility in between, and now we're solidly in bear market territory. We had a little bit of a rally last night after the Fed's meeting because basically the market seemed happy with the Fed's plan. And of course, the futures are indicating that we're going to have a lower market today. Here's now, let's say, okay, now that the market is down so much, are stocks cheap? And the answer to that is that stocks are not dirt cheap right now. But for the first, if you think about it, for the last couple of years, when Tony and I have been speaking to you, we've been saying, well, stocks are expensive, but there's really nothing else around in town because interest rates are low. And now, well, interest rates are still low, even though the Fed has been raising rates. And now stocks are sort of, below average in terms of their valuation. So if you're buying the stock markets now, you're buying something that's a little bit cheaper than normal, right? So is that a good deal or not? So just to make clear what the chart you're looking at, you have the long-term 10-year average PE of 8.1%, and now the forward PE is around 16.6%, right? So let's say, so at the slide there, I said stocks aren't dirt cheap. Well, I said percent, 16.6 times earnings. If, back in the 1970s, U.S. stocks were trading at 10 times earnings. But of course, back in the 1970s, U.S. interest rates were, above 10% or much higher than they are now, maybe around 8%. So if you think of that, with interest rates now still only around 3.3% for the 10-year, that 16 times earnings looks pretty cheap. And here you can kind of see it in a chart. This table graphic was made some time ago. So right now, what you have to look at, imagine here, let me do a little bit of drawing right now, is, here we are with, 10-year bond yield would be here. The PE would be here, right, around 16 times. So if you draw a line across, you would expect the PE is reflecting interest rates of being over 5%, but here we are at 3 and something percent, okay? This thing here says current PE at 18.6 times earnings. That's the that's the historic PE. But anyhow, to get to what I'm saying is, so what is the explanation here? I mean, you could say part of it is stocks are a little bit cheap relative to interest rates, but then you could argue that stocks should be cheap right now relative to interest rates. Why is that? Well, you can say you can say that because what the market is doing right now is pricing in a recession. So if you think that there's got to be a severe recession next year in the U.S., which most people are thinking there is going to be a recession, stocks probably aren't great value. If you think that it's got to be a mild recession, we seem to have already priced that in. And here's some other positive things that we can say about the market. All those young people who are throwing money into meme stocks, according to Goldman Sachs analysts, those popular retail stocks, those all been sold. So those people are out of the market. Daily trading volume is not as down as much as you want to. That would expect it to be. That would be a good sign that the market was near a bottom. However, if you look at like Robinhood's trading, that, this is pretty old data from their quarterly report, that's down quite a bit. So if you talk about the pure retail people who are jumping in and doing stuff, I mean, those people are out of the business, are trading much less. So that's a sign of a lot of the froth out of the market. And if you look at Robinhood's share price, it's even down more than where it is on this chart. So if you think about Robinhood is currently trading at a discount to the cash it has in the bank. So people are predicting that the business has got to be very bad for Robinhood going forward, which of course that's also a sign that the stock market is bad. So does that mean you don't want to buy? No, that's a reason to buy because it means the retail investors have already left. Okay, and I earlier said that the stocks already reflect a recession, and this is just a nice table which shows you that whenever you have a bear market, there's a very good chance, which we're in now, there's a very good chance that we have a recession, right? So you can see nearly every time we had a bear market, you have a recession. But so that's once again, sounds like a bad thing that we're going to have a recession, right? But in reality, it's sort of a good thing because it means the market has already priced in a recession. So if it's a mild recession, it's already priced into the market. If it turns out there's no recession, of course, that's great. And if it turns out to be a severe recession, well, like stocks are still probably too expensive. Okay, so going forward, for the rest of the presentation, we're going to just talk about a bunch of individual stocks. I've been doing a lot of big picture stuff here at the beginning, and to see, by just looking at individual stocks, are we going to learn anything about the pricing of stocks? And just remember, what happens when you're in a bear market, pretty much everything goes down together. And when you get the recovery in a bear market, everything sort of goes up together. So just remember, what you buy at this particular time is not necessarily the most important thing for you to look at. It's really a question of when you buy is the more important thing, okay? So this list here is not our list. This came from a story that my colleague Jeffrey liked from Yahoo Finance, and it just highlighted some beat up stocks with low PEs. And so we decided to take a look at a handful of them because we thought they would be interesting stories that, could give you a variety of different companies, how they're priced right now. And so you get a feel for what the market's like. So those companies are Exxon and Tech Resources, which is a mining company, the big box retailer Target, and of course Starbucks, which we probably talk about a little bit too often. But the reason it's so interesting is because of the labor problems there are really indicative of the inflation problem that we're having in the United States. Okay, Tech Resources is the first one. And one of the things that you have to think about with a mining company or deep cyclical like a mining company is that when prices are going up, often the PE is going down. And so if you're looking at the purple line down, that's the price, and the line below, the bluish greenish line, that is the PE. And you can see the PE right now of Tech Resources is at the low end of the range, 6.8%, 6.8 times, even though the share over the last 2 years has gone from $10 to $40. So basically what this means is this company is just making a lot of money mining. So the price of its commodities have gone up a lot. So let's take a look at what it mines. It has zinc, which is usually not a very interesting commodity. I'm sure that's doing okay. But it has coking coal, and it has coal, regular coal, and tar sands. Okay? So if you think especially of that tar sands business, I mean, that is a business that you can ask yourself, how long will it last? Because, tar sands is very expensive oil. And if you believe over the long term, the demand for gasoline is going to drop as people drive EVs, you better be making a lot of money right now because your business in the future is not going to be so good, right? So it makes sense that this company trades at a low PE. That's the point I'm getting to, but still trades at a low PE. Okay, so we're going to compare it to a couple of other resources businesses, right? And first thing I wanted to point out is your first port of call for looking at which one's the cheapest is the PE, right? So if you look at these different resource companies, which one here has the lowest price earnings ratio? And I'm going to get my pen out here, and we're going to take a look at the PE, and here it is right here. And you can see The lowest one is Mosaic. Well, Mosaic is an agricultural company which has a very short cycle. So as things are booming now, it's likely to be the one that is less booming later on. Mosaic makes fertilizer. Right now, grain prices are high. That encourages farmers to fertilize as much as possible. So there's very good demand. And because Russia and Belarus are major exporters of potash fertilizer, which is Mosaic's main product, Mosaic has, it has another benefit going for it. But of course, a lot of that Belarus and Russian potash will find its way to market. It just won't find it so easily. And of course, Mosaic has competitors outside of Belarus and outside of Russia. And so if you're a fertilizer maker, they're all expanding their production. So the answer is this thing probably won't last. But nevertheless, this company is trading at less than 5 times this time's earnings. So its PE can earn less money next year and still be a pretty good stock. Okay. When I started, I said PEs are the first port of call, but you also want to look at EV versus EBITDA, because, when you're looking at a company like this, PEs can be a little bit misleading because, the PE can be enhanced if the company's levered, right? And of course, in a cyclical industry, you worry about companies being levered. So if you're looking at the EV compared to the cash flow, the EV includes the debt of the company. So you get a better feel for, the cheapness of the company by doing it that way. Okay. So if you look at it this way, the cheapest by far is a company you've probably not heard of, which is West Fraser Timber. And West Fraser Timber is a lumber company in the U.S. and North America and Canada as well. It's really a Canadian company. And so why is that trading at such a low PE, even though it's making lots of money because the price of its products are very high? Well, a lot of lumber and timber is used in the home building business. And home building, of course, right now is doing very well. The U.S. property market is very strong. But with interest rates going up, mortgage rates have gone for a long period of time. U.S. mortgages were below 4%. Now they're above 6% for a 30-year mortgage. So that's going to hurt the U.S. New home building market. It's going to hurt affordability for buying newly built homes. And that's got to hurt demand for West Fraser. So that's why it's trading at such a low PE. But it is, low EV versus EBITDA and a low PE. But it is a very cheap stock. And so now you have Tech Resources, right, which got pointed out in Yahoo article because it is trading at a very cheap level as well. There's the PE, but you can see it as a very low forward EV versus EBITDA. But you got to remember it has a lot of coal in it. So if you compare it to these better known miners, Rio and BHP, it's a bit cheaper. They have more copper and they have more other things that are going to be in tighter demand. So it actually makes sense, the pricing of one versus either. So nothing in here jumps out as a bargain. That's what I'm saying. Anglo America is, of course, a little bit cheaper, but they have coal as well, which is something that's deserving of a lower margin. So what is the message that I'm taking away? You sit there and you turn on the TV and the stock market's going down every day. I'm wondering, oh, it's really bad. But, the market is getting cheaper. Look how cheap these stocks are. So don't get all bearish at this point now. And the other thing is that among these stocks, they're all kind of priced rationally. So if you did want to, well, I'm getting a little ahead of myself here. I'll let myself get ahead of myself. If you did want to invest in them, it may just be easier just to buy the ETF. You can ask Tony if he has a different ETF he likes. This is the one I always like, the GUNR, which is the Natural Flex Shares Natural Resources ETF, and it shows what stocks it owns in there. If you're looking at the number 3 stock, Nutrien, that's a competitor of Mosaic, which I was talking about before. If you look at the share prices, the other thing that's going on right now, which I'm going to turn you off, is, typically when the Fed starts raising rates to get inflation under control, right, that eventually that starts pressuring down the commodity prices. That has really not happened yet, but you can kind of see the worry about that showing up in the share prices of Tech and Mosaic. If you're wondering why did this West Fraser, which is doing very well, why didn't it go up as much as Tech and Mosaic? These two companies have the ability to grow their earnings because, Mosaic can produce potash more quickly. Tech can mine a bit more quickly. They can certainly do their business in tar sands more quickly. But West Fraser, it's limited by how quickly the trees can grow. So that's probably also a reason why it doesn't, it didn't take off like these other ones. Okay, so now we're on to the next stock. And this is one we talked about in the May webinar. We talked about Target, and we did this exact same comparison, which is even more extreme now. And basically, we said Walmart and Costco are both classified as consumer staples companies because they sell a lot of consumer staples, right? They sell a lot of food. Other than that, there is a great deal of overlap between Walmart and Target. Costco is really, really about consumer staples. It's all food and cleaning equipment, cleaning detergents, and all different things. They sell other stuff as well, toilet paper, all these things. People really go for their staples at the Costco. So Costco, because it's selling staples, and that business is not going to decline during a recession because people still have to buy staples, because Costco sells at low prices. It's a preferable way to shop. It's managed to maintain this very high PE. Just a little trivia for you. Costco is well known to be a cheap retailer of gasoline, petrol, and that brings people to the stores, right, to buy other things. Walmart then, of course, is somewhere in between, and Target, which has a lot more discretionary items, is trading at a much lower PE. So I already said, we mentioned that back in the May webinar, and we said, wow, Target is priced so cheap, right? It probably, I kind of said, it's funny to compare Target to Facebook, or what's now called Meta, but I did the comparison because I said, well, Facebook Meta was looking really cheap, and then its earnings came out, and you found out why. And I sort of predicted you would see the same thing happen with Target. And sure enough, Target released its earnings, and the share price went down quite a bit. You can see Target is the red on this slide. And what I had suggested in the May meeting was, well, maybe then after they came out with bad earnings, you could look at this as potentially buying it because it was very cheap, and you would sort of be getting beat up a second time. And that certainly happened after it came out with the bad earnings. Its stock has rebounded a bit. But interestingly enough, the company felt a need to do another announcement to say that, it really is struggling with a bunch of inventory that it has the wrong kind of inventory. What does that mean? Well, Target basically had a bunch of stuff that was selling well during the pandemic, like garden furniture. People weren't traveling. They didn't want to be locked in their house. People have backyards, wanted nicer garden furniture so they could enjoy themselves in the backyard. Target had a bunch of that, and then it wasn't selling. So they were stuck with it, and they had to discount it to sell it. And that's going to hit its earnings. So something like that, this is a retailer with a good reputation. They'll get their product line straight. So obviously this year's earnings are going to be hurt by their discounting, but it should right in the stock. Once again, don't get all bearish about the U.S. stock market. You have stocks like Target are priced very, very cheap. Does that mean that Walmart, shouldn't be priced more expensively than Target? Yes. Does Costco look a little expensive? Yes. But my point is that things are cheap. When you start seeing lots of stocks trading below 10 times earnings, right? That tells you that the market is not, the market, is not terribly overvalued. Okay, so here we go. I just sort of showed you here so you can see that, Target's earnings were not very good. Okay, so the next stock, and like I said, we'll slow down on talking about Starbucks for a while because we do it a lot. But, why do I call Starbucks zero to hero? Well, traditionally, Starbucks traded at a much wider multiple than Yum and McDonald's. Why? Well, it's just a better business. I mean, think about it. When you go into a McDonald's and you buy yourself a McDonald's meal, it's pretty cheap. You're getting pretty good value. When you go into Starbucks and you pay $6 for a cup of coffee, you're not getting very good value. So it's a much better business than Yum and McDonald's. So it should deserve a premium. Of course, if you're listening to me talk and you're a thinker, you'll know that Starbucks is selling a little bit more than the coffee. They're selling the fact that it's a nice place to sit down and talk to your friends, okay? But let's keep going here on the Starbucks. So Starbucks had a bad period, for a while because, it had too many stores in shopping malls. And shopping malls were shutting down and getting less foot traffic in the U.S. They've taken care of that. Starbucks was getting growth because they've expanded so much in China. That helped them, as well, improve them. And now you have, China, they're not expanding in China at the pace they were before, so it won't be that sort of growth driver. And if you're asking why are they slowing down, well, they already expanded a lot, so it's sort of natural that they would slow down. And then secondly, you're going to have the problems of these COVID shutdowns in China. That will hurt Starbucks. And the other major problem that Starbucks is having is the nature of their business, where Yum Brands is generally like a bunch of, it's not low-paid workers who are taught to make food like they're on an assembly line. Starbucks pays their workers a bit more. They get a higher quality worker, and that worker is cross-chained. And so a Starbucks worker is really capable of doing many different jobs at the location, right? So that sounds great. They're already paying more. So why do they have the labor problems? Well, precisely because those are better employees. They feel that they have better options, and they want they want to unionize so they have better work conditions. A lot of the issues are about scheduling, when they can work, when they can't work. So as of right now, 100 Starbucks stores have voted to unionize, and that's likely to continue to grow. But Starbucks has 14,000 stores, right? So 100 stores, if they went on strike right now, Starbucks would just say, yeah, forget about, let those 100 stores sit empty, not make any money, and they would concentrate on the other 13,900 stores in the United States, right? But so the union has a long way to go before they can demand anything from Starbucks and go out on strike. They need to get thousands and thousands of stores unionized. So actually, that's kind of a good opportunity for Starbucks, because if the economy's slowing down, if the job market's less tight, you're going to have less inclination among those workers to unionize. But I think Starbucks is just handling this thing all wrong. They're creating a lot of antagonism with the union. People don't like to be pushed around. Howard Schultz is back as their chairman. Their CEO. He's their he really wasn't the founder, but he's the guy who made Starbucks what it is. And he's saying, I don't want to even engage with the union. And, that's real egotism for one thing, because it's, that's what every company does when they have a nascent union forming, but you don't say it out loud because technically it's illegal. You're obligated under the law to negotiate with the union under good faith. You could just fake it. But he's basically saying the bad thing out loud, and I think that's just going to antagonize his employees and make them want to unionize more. So I really think Starbucks is just a company that's just doing everything wrong right now. That's not why I like it. And it's not the coffee business, because like I pointed before, you have think about how all these IPOs, hot IPOs, the stocks are down a lot. But Dutch Bros hot coffee IPO is still way above its IPO price of $23. So selling coffee is really not the problem. Okay, among the stocks that we've mentioned, the one we like the most is none of them. The one we've been recommending is Yum China, which had been doing pretty well until the last couple of days, where it got swept up in the selling. Yum China, yes, we have these lockdowns going on in China, but during the lockdowns, Yum China is continuing to open up stores. And when, the lockdowns end in China, it's going to have a bigger footprint. It's going to have better earnings. And we're also going to find out whether the Chinese like Taco Bell and tacos and burritos, because they've finally started opening Taco Bells in China aggressively. So that's the one of the group that we like the most. And to remind you all, when we first recommended it and said we were recommending Yum China, we said this was the first time in, we've been always looking at what's cheaper, Yum or Yum China. And we always thought that Yum looked cheaper than Yum China. This is the first time that we thought Yum China looked cheaper. Okay, Exxon. Well, according to Joe Biden, Exxon is making more money than God. I mean, this is very, you have an inflation problem in the U.S. The old expression, the buck stops here, and Joe Biden's the president, and he's getting the blame for the inflation, even if he's not really the problem. And instead of, and what does Joe Biden do? He blames Exxon, for the prices, when it's obviously not Exxon's fault. But basically, Exxon's stock is up 48%, which compared to some of those resource stocks isn't up a lot. What has been causing Exxon's price to go up a lot is crude oil prices are up a lot. And one of the things I pointed out last time, I just want to point out again, one of the surprising things about about oil is that, given the way the price of oil has gone up so much, you would expect that, the world is consuming more oil than it's producing. But in actual fact, at this point in time, there is still slightly more oil being produced than consumed. It's just that stocks are relatively low, and this year that people want, the market, in order to keep prices stable, wanted to see a significant stock build in oil supplies. right? The market wanted a stock bill so the market would be stable, but instead the market has remained tight. It remained tight initially because OPEC was not, because demand was coming back more quickly than expected as COVID lockdowns ended. And OPEC, the oil producing cartel, did not increase their production as much. They didn't increase their production. They already planned increases, but they didn't do more than they originally planned in reaction to that good jump in demand. So things were tight. And then we had the war in Ukraine, which basically is reducing some production from Russia, not a lot of production, but some production in Russia. So you put it all together and things are tight, but production is still exceeding demand. So things aren't dire, right? And so if the raising interest rates does react in a recession in the US and Europe, that will reduce demand, just as last month the lockdowns in Shanghai were reducing oil demand, and that should loosen the oil market. The other thing you could say about oil, which you could argue that thing is Joe Biden is, talking about, blaming Exxon, and it's not just the price of oil that's gone up, and Exxon, of course, is a major oil producer, but Exxon also refines oil, which is not, which is a decent part of their business. And oil refining margins, called crack margins, have simply gone through the roof, right? So if you look at this chart here, look at the green line. Well, you have this is using futures to calculate the crack margin, which is a little bit different than the actual crack margins that they have at the refineries, but it still moves in the same direction. And you can see normally those crack margins are around $20 or a little bit less. And now you're over $50. So you basically have an extra $30 a barrel of profit at those oil refineries. So what's going to happen going forward? Well, you know that those margins are going to come in, right? Because they always do. So they're either going to come in by the price of oil the price of oil going up, and the products that are made, the gasoline, the jet fuel, the diesel fuel, not going up, or the price of the products are going to go down. Ordinarily, as we say in this chart, the products lead, meaning that the product prices have gone up, the oil price is going to follow. So we'll have to figure out whether that's going to happen or not. So that could mean that the price of oil could go up, $20 or $30 more. My inclination is that it won't, but historically, I guess I wanted to, I'm just sort of showing the other half of the view. You could argue that it could. Now, why are refining margins so wide? Well, refining margins are partly wide, like in the United States, for example, because a couple of refineries shut down during COVID. And you build a new oil refinery, yes, margins are really good now, but you can see this year we're reaching peak demand for passenger vehicles that run on gasoline or diesel. Starting next year, they start dropping. So if you're why would you buy an oil refinery if demand for your products, to meet demand, which is currently, very strong, if that demand is almost predictably going to decline. And of course, the decline that's going to happen in 2023 and 2024 are not very significant, but you can see in this chart, it's going to pick up. And by 2024, demand from vehicles, which is a major part of demand for gasoline, is going to be down by almost 50%. Okay, So I was just talking about oil refining margins. A pure play in oil refining margins is this stock, Valero. This is a big oil refiner in the U.S. And you can see refining is where it's at. Their stock is up a lot more than Exxon's. Okay, we are done with the presentation, except for I wanted to do a review of like what are my favorite stocks among the Fang Man. And of course, I did this ranking kind of accidentally in January. And then, you know, I kind of kept it up because I did it, you know, because my predictions worked out really well. And then I redid them in April. And when I redid them again, I reordered them. I said, well, you know, the odds are we'll find out that I wound up getting it right in January because of dumb luck. And I'll probably get them completely wrong in April. But it looks like my luck is continuing. So let's just go over what's going on here. If you look, the two stocks that I put my favorite, they're down the least. If you look at the stocks I have in the middle, Meta and Apple are definitely in the middle category. And if you like the ones that I like the least, they're definitely in the least category. So really, I only got one wrong. I got Netflix wrong. Originally in January, I had that in my least liked territory, and it dropped so much between January and April. I thought, well, it still can't be in my least favorite, and I shifted it over to the middle. I obviously shouldn't have done that. But just to remind you all of my logic there, I said that earnings call for Netflix was just so terrible that I just couldn't imagine that it would actually come to pass and their business would be so bad. But as you can guess, we continue to hear bad news from Netflix. I mean, what they're trying to do is just squeeze out additional revenue from their existing clients. The latest news that you hear from them is that they're going to go after your ability to binge watch shows. So one of the fun things about Netflix is, you know, when a series came out, they would put all the episodes out there at once. And if you were a crazy person, you could just watch all the episodes of Stranger Things for the season 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Currently, I'm watching The Lincoln Lawyer. I'm not binge watching it, right? But it's very good. So I could have binge watched it all watch. And basically, the ability to binge watch means that people can get their Netflix subscription, watch all the shows that they want to watch over a couple of months, and then cancel it and switch to Disney for a while, maybe switch to, if you're American, the NFL network during football things, so you can watch American football programs or college football program. So basically what they want to do is change those rules a bit so it's not so easy to catch up on all your shows over a short period of time. And basically, if they do that, I won't like that. So I think that's going to hurt them. So anyhow, I kind of went a little bit long on Netflix, but basically things are, you know, and I'm more or less saying that to let you know, okay, the stock is down huge, you know, so you got to remember it had a lousy Jan-Feb, you know, from Jan to April. And since April, it's been lousy again. So some of you people might be thinking, oh, maybe it's good value here. I'm still not putting it in my favorites. I'll redo this thing in next month to let you know. Really, I wouldn't be changing these rankings right now. The one that I would be most tempted to change the ranking on would be, its famous last words would be Meta. Because that is down so much, it does look very, you know, it's a company with a lot of problems, but it is trading at very cheap levels. So we'll see. Okay, I'm done talking and we're ready to get into questions. And I'm going to say, Tony, can you hear me?
Yes, I can, Paul.
Okay, so we're getting into the questions. Okay. So someone's asking about specific stocks here. Tony, because we don't really analyze these stocks, so we kind of hesitate to, to kind of give a firm answer on all these. But the stocks they're asking about are all Cathie Wood type stocks, Tony. So maybe you can opine a little bit generically. They're Teladoc, Shopify, and Zoom. Do you have any comments?
I mean, they're all in the category of stocks that are considered expensive. Zoom, you can argue, is not, but it's in a category of, let's just say it has lots of competition. I know, you have Team and other things that a lot of more people are using because it's free. But I would say they're not in the favorite camp. I know Cathie may like them, but as a general matter, these are not types of stocks that people are looking for a recovery. If there's going to be a recovery in the bear market, it's going to be in these much more solid companies that have sold off dramatically.
Right. Okay, so the next question is on fracking companies. It's kind of an interesting question because, I'm not trying to, that he's saying, are they still producing? What's their oil price? So basically, the fracking companies right now are doing extremely well. That's why Warren Buffett invested in Occidental, and there's several more. And, once again, maybe Tony will talk a little bit about the politics, but if you think about it if you're managing those companies, most of the ones that exist now had near-death experiences, when oil prices were crashing because they were spending too much producing and they didn't have margins, etc. So now that times are good, they are being conservative about expanding their production, yet they are expanding their production. And like I said, they're trying to not get overstretched. So the answer is these companies are doing very, very well. But of course, the price of their share is going to go up and down with the oil price. Do you have any additional comments there?
As I mentioned, I was not a fan of the energy investing for many, many, many decades, quite frankly. But in the last year or so, I saw the opportunity for the first time that it became investable because of the policies and lots of reasons, and they've proven to be the case. I think you're going to still see money going in there. To be honest, it's the most crowded trade by hedge funds and institutional investors right now. So there's always that fear that once these things get crowded, everyone wants to exit at the same time. It seems to have been the pattern now in these sectors that get crowded. But there's, the way things are going, though, I think we still have a good runway to the upside in energy stocks. You got to remember, they're becoming, I don't want to talk about fracking specifically, but energy conglomerates like Exxon, Chevron, these are becoming energy companies, not oil companies. They continue to move in that direction. So it is, to me, an investable segment. It's a very small part of the S&P 500, but it's growing. And as they become more and more diversified in terms of energy, carbon capture, all these environmental things, that's happening actually within these companies. It'll be interesting to see where they go. But I guess the long story short, everything's pointing to continued high energy prices, and until you have a material change in, let's say, Russia, that may open up some markets. I still think that these things are investable, but you will see some profit taking here too, as people fear a recession and what the impact might be on general oil prices.
Right. And just to go into, like, if you look at a company like Exxon, even though the price of oil's through the roof, they're spending less money on exploration than they have in the past. So that would be the criticism of Joe Biden. But you can't, blame them, right? Because, Exxon is really lousy at doing small oil projects, right? They're incompetent at it. What Exxon and Chevron and BP Amoco are good at are doing gargantuan oil projects. So it's sort of an all or nothing for them. And if they decided to, jump in and do a couple of big oil projects, they would make their investors very nervous because, the paybacks on those projects are a long period of time.
Yeah.
And if it's oil specifically, right, oil demand is going to start dropping. And are you certain you're going to get those high prices over a long period of time? Because if oil demand drops, the world's if oil demand drops, oil demand can be satisfied by cheaper oil that comes from Saudi Arabia, Iraq, Iran, Venezuela, so they would start pumping again, that have much lower costs of production. So the next question, so anyhow, we answered a lot in that little answer there, but the answer is that the U.S. is fracking, and they're just not ramping it up as quickly as the politicians would like, but it's totally explainable why. In fact, if they were ramping up as much as Joe, if they were ramping up like crazy, the market would get angry at them and say, "What are you, crazy? You're asking for problems like you had, 6-7 years ago."
Hey, Paul, part of the question was the break-even point. I know we had discussed that as previous seminars, but I think something like $35 roughly for U.S., like $9 or less for Saudi. I mean, it depends where the oil is coming from in terms of break-even points.
I mean, the total cost for the frackers is probably, if you add their cost of capital, is probably around $60, right? But their cash costs are much lower. So if you imagine that they, anyhow, they're doing really well at today's high prices, that's for sure.
For sure.
So would the Fed need to increase the rate to more than 8.6% in order to bring down inflation? How long would it take effect? Well, the answer to that is no one really knows. But if the Fed took interest rates up to 8%, inflation would be over very, very quickly. But it would be slamming the brakes on the economy, and all the people who take part of the economy would be like passengers in that car, and they'd all like wind up going flying through the windshield or banging their heads against the windshield. You don't want to happen. So the object of the Fed is to raise interest rates, get inflation under control, and not slam the brakes on the economy. So why the current, so let's kind of put things in perspective. Our best look at what inflation is likely to do is we get from the TIPS, the Treasury protected securities. And that kind of tells you, okay, that we're expecting over the long term, like a 2.5% type inflation rate. And then if you look at what kind of yield, you're getting from 10-year treasuries, well, you're getting right now, I think the treasury yield is 3.2%. So you're basically getting a 70 basis point positive yield, right? Real yield. That a year ago, it was like negative by more than 1%. And that's why we're having inflation now. They had negative real interest rates for a long period of time, and now we're paying the price. However, historically, 70 basis points, although it's a lot higher than what we had before, is not enough to quell inflation. So you could argue that the Fed would have to take interest rates to, closer to 5% to really get real rates high enough to crush inflation. So that's a real legitimate argument. And my view, which I've kind of said before, is I don't think that's going to be necessary because there's so much debt and froth in the U.S. economy. Just raising rates as much as they are planning to do now will be enough to just cause all these little blow-ups here and there, and that will slow down the economy enough that it'll get inflation under control. So the way things are unfolding is right now you're having all these like crypto funds blowing up and things like that happening. Over in Europe, all of a sudden you have this little panic outbreak because of Italy. So you're going to get these little things, and all that's going to weigh on the economy. And we're probably going to have, as they continue to raise rates, we're going to have more negative surprises. And those negative surprises, on one hand, are bad, but on the other hand, they're part of the process of getting the inflation out of the market. Okay, someone asking here, I don't even have that number memorized. Jeffrey's sitting next to me. Let's see how cheap is Meta now? Tony, do you have that number in your head?
I think it's 9. I mean, PE. It looks extremely cheap, but yeah, it certainly does. I think the problem with Meta is not.
Jeffrey just screamed out the answer. What is it, Jeffrey? That trailing or forward? Trailing earnings is 12.8 times, and it's growing its earnings. So
yeah, I was talking about forward.
Yeah. So basically that looks so it's a company that has a lot of problems, but it would seem like those problems are priced in. Okay. The next question here is, how long will this U.S. bear market last? Tony, why don't you give your best guess?
November.
Right. So, and I think when someone asks a question like that, he's asking when you expect the market to start trending higher. But just to point out, the technical end of the bear market is when it takes out the old, the old high. But that could be a couple of years before we have that happen. But in terms of the market trending forward, Tony thinks we'll start seeing it in November. And then the second half of this question is very good. What signals to look out for to detect a possible turnaround?
Well, that's exactly the point, right? So there's, we talked about it at the last seminar. There's 3 or 4 legs here, right? One is a change in the Ukraine-Russia situation to the positive, obviously. Not seen. In fact, there's concern that that's going to expand into broader European conflicts. A change in China COVID policy, and then China-Taiwan posturing. The conference that just took place in Singapore last week, I'll share with you, spooked a lot of institutional investors with the type of rhetoric that was being talked about over there. And the third is the Fed's policy towards inflation. I think, as we said last time, the Fed is starting to get it right. I would have loved 100 basis points yesterday. Let's just get where we got to get to quickly. It's this long drag, getting there slowly, that's been painful to the market. And then the fourth is the policies of the Biden administration using fiscal policy to address some of the issues, as well as energy policy. Forget it. That's out the window. These guys they don't know what they're doing in terms of running the business of the U.S. economy. So you've got 4 things out there, and 3 of them have to do with the egos of people, and those egos seem to be becoming more and more recalcitrant. So I don't know what's going to change this other than, and the reason I say November is the only catalyst I see is the election. I don't know if that's enough, but at least it's a catalyst that maybe can have a change from what we're seeing today. And that's what this market needs, is something that changes that people perceive to be a good thing. And that's what's missing right now.
Okay, so the next question is, what do you think of fixed income? So I'll start that by saying that we're not going to have our regular, the U.S. market webinar with Tony next month, because Hian will be having its analyst week. And I believe, this could change, but I believe I will be speaking at analyst week with our unit trust analyst, Shuley. And I think we will be talking about a couple of fixed income funds. But generally, what happens is with fixed income, so I just want to get you thinking broadly. When interest rates go up, obviously the price of the bonds drop and you have a capital loss, and that's painful. But the higher the interest rate, the capital loss becomes less painful. So what do I mean by that? Well, think about, let's say, a bond fund, it was yielding 10%. And then interest rates went up, and the average, the bond holds a lot of fund, bonds that are 10 years. And interest rates go up by 1%. Well, that bond fund will probably drop by 10%. But during the course of the year, you're going to get a 10% yield, so you're going to wind up flat. So when interest rates are really low, if interest rates are 2% and interest rates go up 1% from 2 to 3, you're going to wind up losing 8%. But when interest rates are 10% and they go from 10 to 11, you wind up flat. So fixed income, it's a very simple way to think about it. It sounds so simple, Mike. The higher the interest rate is, the less risky it is. So we've definitely gone from a point where the risk reward of fixed income was terrible to now, with interest rates higher, the risk reward of fixed income investments are mediocre, which is way better than terrible. But it's still not a great deal. So what if you're going to characterize the market, that the government, the safest bonds, have sold off a lot, and that's where you would go. The bonds with credit risk, the credit spreads have widened out, making them slightly more attractive. But credit spreads were so tight to begin with that widening out by the amount that they have is not significant enough to make credit spreads look attractive going into if we're really going to have a recession, even a mild recession. So the short answer to your question is, right now, if you just want something to do with your money, you're now finally getting a better return with bonds than in the bank. You want to buy low-risk bonds, and you want to buy bonds with relatively short maturities, 3-4 years. Okay? And that sort of answers the question. And if things continue at the rate they're going, you'll probably have an opportunity to really get something attractive in fixed income, in a month or two. I mean, I was just looking at Latin American debt. These are U.S. dollar debt of Latin American corporates. In the fund I was looking at, it's all junk. It's double B minus is the average rating, and that fund was yielding close to 12%. For double B minus, that's very attractive. Now, because Latin America is kind of foreign to me, it's foreign to you, I'm not going to advise you to buy it. But it does tell you things are getting more attractive. What's your view of how long the S&P? There's no way to actually call a bottom when you're in a market like this. You just have to choose a level that you're confident will eventually work out, and you got to buy at down 20%. Once you're in a bear market, most bear markets get a little worse than 20%. So I think, what you have to look at is every time we're down, you can buy a little bit, you got to buy a little bit. If we're down 30%, right, you definitely should load the boat. If it turns out we go down 40%, you just say, well, I bought it down 30%. It only went down 40%. I did a pretty good job. Of course, if you hold out and say, I'm not going to buy anything until it gets to 30%, you wind up missing this big sell-off. Just remember, for the last 50 years on Wall Street with all these hedge funds, the biggest money were made by guys who loaded the boat when the market sold off. So does that mean that that strategy always works? No. But does that mean that it's a pretty good strategy? Yes. Tony, do you want to add anything to that?
Yeah, I think we showed a table of that previously, and I think it's always worth remembering that that these events like this are typically, look, this is the year that may be down, but when you have something like this, you have 7 years of up. So if you're a long-term investors, this is the best way of creating wealth in the long run. If I could share just a couple other things, Paul, just real quick. Some things that a lot of institutions are looking at. If you go to the Federal Reserve of Cleveland, or if you type in nowcasting, inflation nowcasting, they do a daily. So people are looking at high frequency data, right? They're trying to get a feel for predicting where the inflation rate is, because if we start seeing that turn in the inflation rate, that is going to be a catalyst to start putting it in a bottom, if you want to talk about a bottom, because inflation encompasses a lot of the things that I've mentioned in terms of these 4 or 5 legs. So, people are looking at that. That's something that you guys can look at every day. It's posted at 10 a.m. every day, and a prediction of where the next, where the Fed is, where the inflation is going to be when it gets announced. It just gives you some things to start looking at ahead of time, just like institutions are trying to do. But again, it's inflation nowcasting, the thing that should come up is the Federal Reserve Bank of Cleveland, their prediction of that. That's something that people should be focusing on. But it's a little frustrating, guys. Now, look, there's a number of very, very short duration bond ETFs that are out there that are also being looked at. There's a place to go and earn a yield. I'm not, an example, for instance, would be JP Morgan has a very short dated fund that the people are looking at. It's paying roughly 1.75% as interest rates rise. Those will rise too. Basically, they're holding bank paper and other paper that's under 6 months or 3 months remaining to maturity. That's how they generate those type of yields. It's literally almost a money market fund. It's not a money market fund, but it looks like a money market fund in the sense of it's very stable in terms of price, and it's purely a way of generating yield if you need a place to go in a market like this.
Yeah. Just to remind you all, when you get your statements, that if you buy a U.S. fixed income ETF, that when they pay the distribution to you, there will be a withholding tax. But since that distribution is mainly interest, which is not subject to withholding tax, in theory, and so far it's always worked, you will eventually get that withholding tax rebated back to you, okay? So I'm very nervous about saying that because maybe it won't happen one time because of some snafu. But up till now with our clients, they've gotten back all their withholding tax. If you're only talking about a 1.5%, 2% interest rate, and the withholding tax is very small on that, 30% of that. The very first time you don't get your withholding tax back, you just sell the thing off. You're not going to miss out on too much. Okay. Any guess on how long the market would take to turn around? We've kind of given you at least a guess that it's going to happen. We'll say maybe it happens in November. Someone's asking about Netflix and Russia. I just No, I don't think, it's obviously this person's looking at Netflix carefully, but I think the key problem with Netflix is it just has so many users already. It's awful hard for them to grow their users. And right now, one of the selling points of Netflix is you can sign up for it, and after a while you don't like it, you can cancel it, right? That encourages people to sign up for it because it's flexible. But as there's other streaming services out there, that really encourages people to switch from one to the other, and that's what's hurting Netflix. So they have a problem is that they already have really good penetration. They have competition, so they can't raise their prices way too much, although they'll continue to raise their prices. And they have a problem of people subscribing for a while, canceling, and then subscribing again. So that cuts down on their revenue. So I think those are the key problems for Netflix. I don't think the guys at Netflix are really worried about Russia too much.
Paul, if I could just mention, as it relates to that bottom, again, yes, what Paul said is true. No one knows, but people that, as we mentioned before in the fund manager survey, their views are roughly around 3,600. There's some analysts out there, Mike Wilson and others, that are being seriously listened to these days. He's talking about 3,400 in terms of the S&P. Interestingly, he and others who have these, price points that are much lower, they've been there for almost a year now, just to be clear. So these aren't like Johnny-come-latelys to a bear market scenario, which is why people are starting to pay attention to what are these guys saying. These guys were all saying we're going to get there, but not because of a recession. None of them see a recession coming in the sense of huge layoffs, that kind of a thing. They're looking at it purely as a function of multiples for the most part, right? With some earnings slow down from those predicted by analysts today. So, but they're also assigning a PE of roughly 16. So what they're saying is, look, take the earnings that the S&P is going to do, cut it, that analysts are claiming, cut it by 10%, multiply that by 16, you get to a 3,400. So, but those are levels, I think, quite frankly, that are going to be seriously looked at by those who are not investing. If you take a look at the positioning, what's called positioning by institutions, it's in terms of equities, it's lowest in history. It's even lower than the financial. It's amazing how little money right now is, or how underweight people are in terms of equity exposure in portfolios. That means there's a huge amount of money that needs to be put back to work at the point where chief investment officers feel is the right place to do it. And if you needed a guidepost, they could be completely fail. There could be all kinds of things that happen that make these numbers irrelevant. But if you have the status quo, and if the status quo can get a little bit better, somewhere between 3,400 and 3,600 is where a lot of people are thinking that they may want to re-enter the market. I'm talking institutional money. I just wanted to put that out there.
Okay, so we're just going to do 3 more questions. There's a lot of questions this time. I apologize that we're not going to get to all of them, but we can't stay here all night. So the next question here, the first of the last 3 is, why is Amazon in our least favorite? Well, of my least favorites, Amazon is my favorite least favorite. But the real problem with Amazon is that, as you can see, Microsoft is in the favorite because the cloud business is very good, and Amazon is a leader in cloud, so that's very good. But Amazon is also attached to its retail business, which is right now just has to be very bad. You have labor problems. I'm not really talking about the unionization of Amazon, although it's fighting that trend as well. But you have a tight labor market. You're going to have wage costs going up. You're going to have transportation costs going up due to high energy prices. You basically, you're got to have the economy, people spending less money on products and more money on services because, COVID has ended. So you got a whole range of things going against it. So basically you have a good company, right? Right now, Amazon has a good company attached to a bad company. And I think I didn't get to this question. The person asked me, do we think that oil could get to $140 a barrel? And the answer to that is, definitely, because the situation right now is tight. So if there's any kind of supply shock going on, the price of oil is going to go up a lot. But, if there's nothing that happens, I suspect oil will start slowly trending lower. But it's got to be a while before oil will really be able to drop a lot in price. It's going to stay high because there's just doesn't seem like anything in the supply and demand that's going to give a lot. Okay, someone asking my view on Tesla. I'm a little bit, it's a sad thing. The company deserves nothing but praise. I mean, what they've accomplished is beyond anybody's expectations. And I just question whether they're going to be able to build new factories quick enough to expand their sales quick enough to justify their valuation. But, that's kind of my view on Tesla. But, it's cheaper now than it's been in the past. If you like Tesla, go ahead and buy it. It's not like one where I would ever tell you, oh, no, don't do it. Tony said in the last webinar that funds were still not interested in the market until the S&P dropped to about 3,400, for example. Is that still valid, or any update on fund participation or what they are looking at?
Yeah, that's what I just mentioned previously, that remains the area that people are looking at as a potential entry point, barring anything else going materially wrong. Okay, so I'll be somewhat bold. If things get worse in Europe with Russia, in other words, it goes well beyond Ukraine, you could be looking at single-digit PEs for the market. Okay, so you have to understand these are macro geopolitical events that will have a significant impact on psyche of investors, institutional and others, that can materially change what I'm saying here. But so what I'm saying is, things stay the status quo and can get better, we're close to levels where people may want to start changing their very bearish posture when it comes to any asset class, to be honest with you. And that's part of the issue here. The biggest problem we have right now for investors, institutional investors, is there's no way to hedge, right? In the old days, when you had things like this going on, not necessarily inflation, but in the old, for the last 30, 40 years, you just increased your bond portfolio. That offset the downside in equity because let's say earnings were declining. You can't do that here. Every asset class is going down, which is why institutions are simply exiting the markets, right? And that's created a huge, one of the largest pools of uninvested cash, if you want to think of it from that perspective, ever. That will come back to the market. What is the catalyst? That's the thing that people are struggling with. And right now, there has been no catalyst to do that. But prediction, just putting out a number, because everyone gets asked for a number, 3,400 to 36, somewhere between 34, 36, probably closer to 34, is where people are going to start looking to start nibbling. And so does that put the floor in? Barring, again, anything going worse, that could be close to where the floor is. If you start seeing a turn in inflation, that will be a catalyst. Okay, if you start seeing something positive happening on the Ukraine-Russia front, that's a positive catalyst. Same token, those same three things, if they go in the opposite direction, things can get much worse than where we are right now. This is a market unlike any other market I've personally seen. I can't point to a real problem. I can only point to the fears of what could happen. And that's really what's happening in this market. This bear market is driven by fear of what might happen. Interest rates going 8%, inflation going to double digits, on and on. These are fears. The previous markets that we've seen where we've had bear markets, you knew what the cause was. You had potential banking collapse. You had, you can look at these, not potential, they were actually collapsing. Real issues, real companies were going out of business. So, we don't have real events that's driving this fear that's causing this bear market. It's the fear of what might happen that's causing this bear market. So any event that takes that fear away or starts saying maybe I was, what I was afraid of isn't going to happen is going to be positive. And of course, the realization of fears are going to be much more negative for this market. That's a long way of saying, guys, everyone's scared. And when you're scared, you're really just looking for anything to tell you that I need to be less afraid before you start buying. That's what's made this so difficult. A lot of professionals have participated on this downside because it's not like a downside we've seen in the last 20, 30 years. Normally you know why something's happened. Here it's what might happen. It's very frustrating.
Okay, well, I'm sorry for the people we didn't get to the final questions, but anyhow, thank you all for listening in to the webinar, and we know that it's probably likely that that most of your portfolios are down a bit, and so investing right now is a little bit more stressful than it normally is. And so what we're hopeful that this webinar helped you get your thoughts in a row so you have a game plan to deal with it. We wish we could tell you, hey, the thing's just going to turn around and everything's going to be good very quickly. But as I think you all know, that's probably unlikely. But as I just said to you before, just remember that most of the money that's been made on Wall Street the last 50 years has been made by people who buy stocks when they sell off. Mm-hmm. So as a strategy, that works. And sometimes you buy too soon and you have to put up with some pain, but
it will get better.
Yeah. It's better than buying, or should I put it another way? It's better than buying at the high. Mm-hmm. Okay. Okay, have a nice evening. I'll let Ash sign off for everybody.
Thank you, Paul and Tony, for this insightful presentation. For more upcoming webinars, please visit utrade.com.sg. Once again, thank you for joining us tonight and enjoy the rest of your evening.